All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Friday, everybody. The week's almost over, but we got one more to get through. Today is April 11th, 2025. And, the top story this morning, of course, as it's been all week, is the trade war. And we've got a lot of developments in the trade war this morning. A lot of things happening in China, a lot of things happening in the United States. You guys may have heard trade wars are messy for everybody involved. Nobody wins. It's just a matter of who loses the most. And, well, our pain is a risk other people are willing to take. That's what it boils down to in this trade war. So first, let's talk about where we went yesterday and what signals we were getting yesterday. We had more selling yesterday, both in stocks and bonds. All right, so the sell-off was continuing. It looks like that enthusiasm from Wednesday, that euphoric rally that was kicked off by the 90-day pause, it looks like a lot of that may have been misplaced. Now, the one difference I would say with yesterday, the selling was slightly more orderly. It wasn't dropping off a cliff. We were down pretty much steady in a diagonal for most of the day. It was not panic selling yesterday. So that differentiates itself. It wasn't panic selling. It wasn't euphoric buying. It was just slow and steady down. Now, we still have this situation where the bond market was selling off. Yields were rising yesterday, and they ended up closing the day in green territory, higher yields at the end of the day. So that means bonds are no longer behaving, or still not behaving, as the safe haven asset class. That's very important because the bond market is the real risk here. And when we saw bonds selling off yesterday along with stocks, that tells me that although the worst may be behind us for now in the bond market, they're still not out of the woods. All right. But it was at the very least, it was more orderly. Meanwhile, we watched the yen and the euro strengthen all day yesterday, rather significantly. All right. So we've got that yen carry trade risk. That is very real. All right. You have a lot of levered bets in Japan. The consensus seemed to be somebody in Japan was really at risk Wednesday night or I guess it'd be Tuesday night into Wednesday morning. We still don't know who. Everybody's still speculating. That's all we can do is speculate at this point. Nobody knows who it really was, but somebody was about to go poof in Japan. That's still a risk. That yen is still strengthening. As long as that yen is strengthening, that means the losses are piling up for whoever that is over in Japan. All right. And the euro, by the way, money going home, that's been happening ever since that blow up in the Oval Office between Trump, Vance, and Zelensky. Europe's got to build their own military now. They're not going to bank on the United States to come to their aid. And so we have seen the selling of U.S. assets and then those dollars converted back to euro as they go back home, because Europe is going on this spending bender. It's going to be a disaster for Europe in the long run, because what are they going to do? They're going to do the same thing we did. They're going to be a-holes about it, like with the Inflation Reduction Act. They're going to build windmills and solar panels when they're supposed to be building tanks to protect their military. They're going to end up blowing it all. And who knows? I mean, we built all these charging stations, and now we're throwing Molotov cocktails at them. So I'm sure Europe's stimulus is really just going to be wonderful. Great. You're going to love it. Good luck with that. Now, look, while the money has been flowing back to Europe and back to Japan, the money has also been flowing into gold. Gold is telling us something's really wrong here. $240 up in 3 trading days, not even 3, really 2 and change, because today's not over. Gold is ripping again this morning. All right. Gold is flashing a warning sign. Something is wrong when people are buying gold hand over fist. I don't care. I own gold. I'm loving it. No problem for me. I like the shiny. I got my little silver bar here. So, I mean, look, never threaten me with a good time. But let's realize what that actually means. That means trouble elsewhere in the market. That means probably bond market trouble. That means probably jobs are at risk. All right. So be careful celebrating that gold a little too much. Understand what comes along with that. You're like, yes, my fire insurance policy is finally paying off. That means your house burned down. So keep that in mind as you celebrate gold heading higher. Also going on, retail has been buying the dip this whole time. Right? Retail has been exit liquidity for institutional money since the tariffs were announced. Why is retail doing this? Because retail has done this since 2020 and it has worked. Stocks have gone up in a straight line nonstop since COVID. And so they think that it's been this way for 5 years. It's always going to be that way. I am not a dip buyer here. You guys may guess I kind of dabble in the whole pessimism thing. I tend to be a little bit of a bear, or maybe a lot of bit. I wear my perma bear and invisible ink on my sleeve here. I accept that. That being said, guys, retail piling in here as institutional money gets out. That is classic exit liquidity. And meanwhile, the losses are piling up for U.S. pension funds to the tune of hundreds of billions of dollars. Now, over in China, what do we got going on this morning? First of all, they raised their tariffs again. Okay, that's good. We're now up to 125% tariffs that the Chinese have placed on U.S. goods. And the Chinese are saying, we're done. We're not raising tariffs anymore after this because there's no point. And they're kind of right. What are we at, 144% here in the United States? I mean, guys, what's the difference? If you're going to fall 10,000 feet, does it make a difference if you fall 11,000 feet? Okay, it's a bigger fall. You're not deader than you were at 10,000 feet when you fall. So at this point, at 125%, at 141%, there is effectively no trade between the two. So yeah, China's kind of saying that like we're done. This is a joke at this point. We're not raising our tariffs anymore. But, that's like another 41% tariff hike that the Chinese have announced. You can expect President Trump to announce an additional 40 some odd percent tariffs on the Chinese now. So we're going to go up to about 180 something now. Why not make it an even 200 while we're at it? And then we can all move on, laugh about this someday, look back and say, oh, remember the 200% tariffs? That was fun. Also going on. So look, we're all sitting here talking about, oh my God, these tariffs, things are going to be so expensive. We're not going to be able to get certain things. Keep in mind, for every action, there's an equal and opposite reaction. And over in China, today, we're seeing that equal and opposite reaction. JD.com and Alibaba are both scrambling to create new avenues for their exporter clients to be able to sell their goods domestically. They're trying to create new demand for the things they had typically sold to the United States. Because where our problem is, it's going to get so expensive and we don't have any stuff to buy. Their problem is going to be, we've got all of this production capacity and nobody to sell it to. And now all our companies that build this crap are going to go out of business. Oh, crap, they borrowed money to build that assembly line. They borrowed money to buy materials. Our banks are already struggling from this real estate collapse that's going on in China. So, the Chinese, they've got to try to stimulate demand to offset the exports. They've got all this stuff with nothing to do with it. And China's already got a deflation problem going on over there. So I know, why don't you guys build more apartment buildings? There's an idea. You've already got entire empty cities. Why not build another empty city to create demand? And then we'll all be rich. Look, guys, trade wars suck for everybody. They're messy. We have our problems here from this trade war. They've got theirs over there. Nobody wins. Whoever comes to their senses first loses. Also, we've got some interesting things going on with the Chinese stock market. It's up again last night. That's not surprising because China is making it illegal to sell stocks. Oh, now we're thinking outside the box. You don't want your stock market to go down? Don't let people sell stocks. And then I'm sitting here, I'm like, oh my God, they're so totalitarian and it's such a joke over there. And then I remembered on August 5th, didn't we kind of do the same thing here when all of our stock brokerages went down for maintenance at the same time on the morning of August 5th when stocks just happened to be selling off? So I guess maybe I shouldn't cast that first stone because we do that garbage too. And China has placed some unique tariffs on chips. This is interesting. China announced that for semiconductors, tariffs will be based on place of origin, not packaging, not the company that makes the chips, where the chips were made. So they're basically saying, we're not going to put tariffs on NVIDIA chips because we really want those NVIDIA chips, even though NVIDIA is not supposed to be selling them to us, but we want them anyway. So technically, we're going to look at those NVIDIA chips as if they are made in Taiwan, which is factually correct, even though it's an American company that makes it. So a little bit of a softening of the rhetoric there as it pertains to semiconductors. All right, now domestically, what's going on in the U.S.? Our car market is going crazy. Used car prices are going to start surging. I warned about this a couple of weeks ago when I had my buddy Tommy on the channel. We warned about the tariffs are going to drive new car prices so high that it's going to create more demand for used cars, just as there's a shortage of used cars hitting the market because 3-4 years ago we had the chip shortage. Used car prices are going through the roof, and there's a story in Bloomberg to that effect this morning. Watch out, guys. Cars are heading much higher. Tesla is not going to be taking orders in China for certain models that they make here in the U.S. and then export to the Chinese. Well, with 125% tariffs, you're not going to be selling many of those. Meanwhile, we got inflation data this morning. PPI came in and it beat to the downside. Another low inflation print for PPI, actually negative for the month in both core and headline. But guys, it doesn't matter. It's like, hey, great news. I checked the thermostat, and right before the house burned down, it was nice and cool in the house. Okay, great. It doesn't matter. All right. Don't get used to it. Inflation was heading in the right direction for a very short time. We saw the same thing with CPI yesterday, but PPI much lower. It doesn't matter, guys. Now that we're talking 125% tariffs, it's like, okay, great. Now watch what it does in a few months. This was March data before the tariffs were announced. We're going much higher from here. And we got bank earnings. Bank earnings were largely pretty good this morning. JP Morgan, Wells Fargo, Bank of New York, Mellon, Morgan Stanley, all reporting pretty good numbers. We're not going to spend too much time on bank earnings because there's so much other news and I don't want to run too long today. But there was one thing hiding in that news announcement about Bank of New York Mellon that I think we should read and we should talk about because they're spinning it as a positive. I don't really think it's a positive. So stick around till the end for that one. You're going to want to hear that. In the meantime, why don't we shrink my big melon of a head and let's see what's going on in the markets. And this is where I typically ask you guys to hit that like button for the algorithm. And if you guys are new here, how about that subscribe button? Come back tomorrow, have your coffee with the melon heads, because we do this every single day. And stocks were positive for a brief time. You guys may have noticed the bull in the thumbnail this morning. All three indexes were green when I hit that go live button. And there's some redness now. The S&P is down 27 points, 0.5% lower this morning. The Dow is joining them in negative territory here, down about 200 points or 0.48%. Guys, the only thing I got to tell you, especially if you're watching this on record, note the timestamps here, guys. That's the only thing. Things are so volatile. They're moving so fast now. It's like quantum mechanics in action. By the time you observe it, it has changed. And also in the NASDAQ, we are lower by 91 points now, about 0.5% lower. So you can see, guys, there's been a lot of bouncing around this morning. We're heading down kind of in a hurry at the moment. We'll see where this goes here. It's just hard to tell. At any minute now, we could get another retaliatory tariff and the market could puke a few more percent. It's just really hard to predict these unpredictable things. Now, look, stocks have been selling off pretty brutally for the last few weeks. We had that one rip your face off rally in the middle, but one thing has been consistent this whole time. Undaunted retail investors bruised by the S&P 500's big reversal. Retail traders have been buying this whole way down. Individual investors are proving to be relentless when it comes to pouring money into a turbulent U.S. stock market that's been rocked by President Trump's tariff salvos. Emboldened by Wednesday's big rally in the S&P 500, retail investors kept buying even as stocks slid Thursday. They ended the session with $4 billion in net purchases yesterday. It's the fourth time they've broken that threshold this year, according to data from JP Morgan. Retail traders remain undaunted by the market plummet, said Wu, the bank's global quantitative derivative strategist. Despite this sell-off, they continue to buy aggressively. However, the market reversal shows the downside to their unceasing confidence after logging a 17% gain Wednesday and drawing nearly even on the year. The latest equity sell-off pushed them further away from recouping their 2025 losses. All told, retail investors pumped $11 billion into equities since April 2nd, the day Trump unleashed sweeping reciprocal tariffs on trading partners. Data through Wednesday's close shows, so that doesn't even include yesterday. That is significantly higher level than the 12-month average and has been surpassed only about 1% of the time. Guys, retail is buying. The institutions are selling. So exit liquidity, man. That's what it comes down to here. And meanwhile, top U.S. pension funds lost $169 billion after the tariff shock. I think the losses are going to be a lot bigger than that. We've actually seen trillions in market cap go up in smoke here. But the top 25 state and local U.S. pension investment funds suffered an estimated paper loss of $169 billion in public equities after U.S. President Trump's tariff announcement. The losses came in the 4 trading days between April 3rd and April 8th, so that doesn't even include the last few days. Also doesn't include that big rally on the 9th. This is according to the Equitable Institute, a New York-based bipartisan nonprofit organization that focuses on pensions. For the whole year so far, the top funds have lost an estimated $249 billion. The total losses for the whole U.S. public retirement system will likely be significantly higher than that. So retirements are taking it on the chin here. Now, let's look over at what's going on in the rest of the world here. We've actually got the German exchange down about 1.7%. That was positive a little while ago, so some selling in Europe going on here. The FTSE, that's the London exchange, that's modestly positive at 0.17%. The CAC 40 is down by about 0.95%, and the Spanish index is lower by about 0.7. So we've got stocks in Europe are lower here. We've got the euros continuing to surge. We'll look at that chart in a minute. Now, meanwhile, overseas, we got Japan woke up yesterday and chose violence. The Japanese market, after having a massive move higher on Wednesday, on Thursday or yesterday, Japan at the open gave up half of that rally. They were down about 5.5% at the open. Now, they recovered a little bit of that throughout the day. Japan ended up closing down about 3% off of its lows, but the selling continues in Japan. Now, look at these Chinese indexes here. And I've been questioning this all week, saying this is a joke. The Shanghai index 0.5% higher, the Shenzhen 0.8% higher, the Hang Seng up by 1.1%. Guys, there's no way Chinese stocks should be higher here in this trade war. And then I saw this one this morning. Shout out to my moderator, Mish, who has been fantastic with the research this week. By the way, Mish, awesome job, brother. China stock exchanges set up daily restrictions on net share sales by individual hedge funds and big retail investors. According to Reuters sources, the daily net sales are capped at 50 million yuan, which is about $6.8 million. So look, stocks can't go down if we don't let people sell, right? This is the kind of thinking of the Chinese Communist Party and totalitarian regimes. How about we make a law that says everybody has to buy more stocks so our stock market can go up and we can all get rich? All right, hey, that one's a freebie, China, no charge. All right, consider that an olive branch in this trade war. I just throw them out there. You guys do what you want with them. So, guys, there's no price discovery going on in Chinese stocks right now. Don't trust it. Looking over at the dollar, look at this weaker dollar this morning, below 100. We got a 9 handle on the Dixie here, 99.35. That's another 160 basis points lower. Guys, money is leaving the U.S. U.S. stocks are selling off, and the dollar's not rising because as soon as they get those dollars, they're trading them for something else and sending that money elsewhere. Where is it going? Well, it's going to Japan, that's for sure. Look at the yen here, 142.29. All right, we had some support at 144 yesterday. We blew through that last night. The yen is in free fall once again. Look, guys, we are now near the lows of that August 5th yen carry trade panic. Again, that is a major risk to U.S. assets because so many people have borrowed cheap yen in Japan, converted to dollars, and then bought risk assets in the United States with those dollars. Well, those risk assets are going down in value. The yen is going up in value, which means that yen carry trade is getting less and less profitable. They're now losing money off of it. So the only way to get out of that is to sell your U.S. risk assets like Bitcoin, like tech stocks, convert those dollars back into yen, sending the yen even stronger, and then paying off your debts in Japan. So this is a feedback loop. Once the yen carry trade starts to unwind, it feeds on itself, and typically it takes intervention from a central bank to stop that from happening. And guys, watch this yen. It is falling once again this morning. This is a real risk out there. Meanwhile, we've got the euro is doing the same thing. Look at the strengthening in the euro. Now, 0.876 euros to the dollar. You see this chart moving lower. That's the euro getting stronger. And look, guys, it all started in February. We've been falling pretty much this whole time. That blow up in the Oval Office was around here. And then we had Europe pass that big defense spending bill. They got rid of their debt caps for defense and infrastructure. And then the tariff announcement made things even worse. The euro is getting a hell of a lot stronger here, just as the debt piles up in euro. If you owe euros, you're in big trouble here as this strengthens. So that's something to watch as well. Meanwhile, looking over at the bond market, oh boy, did I mention the selling was orderly? Me and my big mouth. Look at what's going on right now. Yields are higher once again as stocks break into negative territory this morning. We've got the 30-year is higher by 6.5 points, 4.913. The 10-year making a big move this morning, 4.496. That's up by 10 basis points. All right, the drama in the bond market is starting up again here. Watch that 10-year yield. Watch that yen carry trade. The 2 years up more modest, 1 basis point, and the 1 month is unchanged here. All right, guys, watch that bond market here. It's going to be a messy Friday. Watch for retaliation on those tariffs. Meanwhile, gold is just ripping. Look at the move in gold here. $3,230 for spot gold. It's up another $54 this morning, 1.7% higher. It's been up $100 or more for the last 2 days in a row. Gold is saying something is majorly wrong here. Look at this gold chart. All right, gold is not supposed to move like this. I own gold. I don't mind. If you want, hey, gold wants to go higher, don't let me stand in the way. But understand what this means for the rest of the market. All right, this means demand for a seat on the lifeboats is going up. All right, now if you don't know what's happening on the ship, but you see everybody with money in their hands trying to buy a seat on the lifeboat, maybe the ship is not in such good condition. That's what gold is telling us right now. All right, let's look at what's going on elsewhere in the market. The silver, spot silver, 31.62. That's higher by 60 cents this morning, almost 2% higher. So silver's getting in on the action this morning. Meanwhile, copper's a little higher. I'm surprised to see copper higher here at 2.3%. Copper is indicative of industrial demand in the economy. So I don't really know what's moving the copper. And we have oil is lower. So copper's not making a lot of sense here. Maybe there's been some kind of tariff news in the metals front. I'm not sure what's going on there. Platinum is higher by 0.8%. Palladium is 1.2% higher. All the metals are up this morning. Crude oil, as I mentioned, is lower by 0.5%, $59.75 for WTI crude. Guys, watch the oil patch here in the States. I did see something in Bloomberg this morning. Some investors are talking about halting drilling in some U.S. oil fields because the U.S. break-even number, we're getting near the break-even price for a lot of domestic producers. The United States has gotten much more efficient since 2015 and the last time there was this price war between the U.S. and the Saudis. So our break-even price is lower than it used to be, but we're still getting into dangerous territory for U.S. oil producers here. And I think oil's probably heading into the 40s before the dust settles from this trade war. Meanwhile, Bitcoin is having a good day here. I don't expect that to last too much if stocks start selling off. $82,104 for Bitcoin as priced on Coinbase. Despite that little leg up we've seen in the last couple of days, guys, Bitcoin remains in this downtrend here, pretty slow and steady. Bitcoin is very volatile, and Bitcoin is highly vulnerable to that yen carry trade, guys. So be careful in this one. Be careful on leverage. Looking over at China here, this is the big one this morning. China raises tariffs on U.S. goods to 125% in retaliation. Good God. It's easy to get desensitized to these numbers because they've been thrown around so much lately. But, man, look at that number there. God, appreciate the absurdity of 125%, 141% tariffs. This is nuts. China retaliated against Donald Trump's latest tariffs by hiking duties on all U.S. goods while calling the administration's actions a joke and saying it no longer considers them worth matching. Beijing will raise tariffs on all U.S. goods from 84% to 125% starting on April 12th, the Ministry of Finance said on Friday. That's after the White House clarified that levies on Chinese goods rose to 145% this year. Given that American goods are no longer marketable in China under the current tariff rates, if the U.S. further raises tariffs on Chinese exports, China will disregard such measures, according to the statement. You know, they're kind of making the point here, guys, like, look, we're already at the point where all trade is effectively dead, so what's the point in killing them again? With tariffs at levels now set to halt most all trade between the world's two biggest economies, the concern now is that the economic fight could spill over into other areas of the relationship. Trump and Xi are locked in a standoff over who will move to de-escalate first. Trump has said he's waiting for a call from Beijing, while Chinese officials have repeatedly said they're open to negotiations but won't be bullied into talking. Things are going to get worse before they get better, guys. All right, now this one. Everybody's so focused. We're here in the States, right? Most of my audience is in the U.S. So we're so much focused on how much more expensive stuff is going to get here in the U.S., and, you know, our job's going to come back. But understand, equal opposite reaction, guys. The laws of physics, Mr. Newton says things are also pretty bad in China here. And we got this one this morning. China's e-commerce giant JD.com to invest $27 billion to help exporters go domestic. Because now they've got an excess of production capacity and an excess of goods in China and nothing to do with it. And that is every bit as big of a problem as a shortage is. China's e-commerce giant JD.com said on Friday, what happened? What happened? Did I click on something here? Oh, come on. Don't give me this garbage. Here we go. All right. China's e-commerce giant JD.com said on Friday it will launch a 200 billion yuan fund to help the country's exporters sell their products domestically over the next year as the U.S.-China trade war intensifies. That's about $27.3 billion U.S. JD.com said in a statement that it would send its employees to Chinese companies involved in foreign trade, directly purchase their high-quality products, and set up a special area on its e-commerce platform to sell these products and direct traffic and marketing support to this area. Separately on Friday, supermarket chain Freshippo, owned by JD's rival Alibaba and known as Hema in Chinese, said it had opened a fast-track path for export companies to explore the domestic market. The support programs for Chinese exporters could help them recoup some of their losses stemming from reduced sales overseas by quickly starting to increasing domestic sales, although they will face intense competition in a slowing economy. Look, there's just no way you're going to make up for U.S. shelves by creating a special link on your website to buy products produced in China, all right? It didn't work here in the United States when we were losing our production capacity and the whole Buy American thing took off in the U.S. It didn't work. We still lost our factories. China's trying to stimulate domestic demand to offset the loss of exports here. It's not going to work, but this just goes to show you they've got their problems too, guys. Nobody wins a trade war. This is going to be a big problem for them as much as for us. Meanwhile, we got this one from First Squawk. This is a Bloomberg terminal print here. China changes place of origin definition for chips imports to manufacturing from packaging. Chinese Semiconductor Association says U.S. chip makers, which outsource manufacturing, which is pretty much all of them, will be exempt from China's tariffs. Chinese Chip Makers Forum says U.S.-made chips packaged elsewhere may be caught by Chinese tariffs. So China's kind of taking a shot at this move to create domestic chip manufacturing here in the States. They're trying to re-incentivize American chips produced in Taiwan because they don't want the U.S. to create their own chip building industry because of obvious military implications. If there's ever a fight over Taiwan, everything that goes boom in the U.S. arsenal has some kind of chips in it. So China's kind of making a little bit of an overture to American chip companies, trying to disincentivize making production here in the States. Meanwhile, Tesla will stop taking orders in China for models imported from the U.S. Look, Tesla stopped taking orders in China for the Model S sedan and the Model X sport utilities, both of which are imported from the U.S. after the countries raised tariffs on one another in the escalating trade war. Look, guys, these two models, they're made in the U.S. and they're exported to China. Even though Tesla's got this big gigafactory in China, it looks like these two models specifically are only made exclusively in the U.S. They're not going to sell them in China anymore, not with a 125% tariff. No way. Tesla already had their problems because BYD has just been eating their lunch over there with their own Chinese domestic EVs. And elsewhere in the car market, pay attention here, guys. I told you a couple of weeks ago, car prices were heading higher. You can see it happening in real time now. I need to buy your car back. Trump's tariffs caused chaos at dealerships. This one's in Bloomberg this morning. We're going to scroll through this anecdote, but when President Trump went forward with 25% tariffs on imported autos effective April 3rd, it set off a frenzy at car dealers across the country. This was the biggest inflationary event for the industry since the COVID pandemic, when automakers went months without being able to make new vehicles. Once work was able to resume, pandemic protocols precluded companies from being able to ramp right back up to normal levels. Supply shortages meant prices shot up, rendering the new car market unaffordable for many customers who snapped up used models. Desperate dealers resorted to desperate measures, calling up customers and pleading with them to part with their vehicles so they had more to offer on the sparse lots. That happened to me like 2 or 3 months after I bought my truck. The dealership called back, offered me more money than I paid for it to buy it back for me. History is now repeating itself somewhat after Trump's tariff shock. This week, I got a panic call from a manager at the dealership that sold me my CRV. This is from the article's author. I need to buy your car back, sir, and I'm willing to pay substantially more than you paid for it, he said. So we are back to that COVID-era nonsense, guys. Cars are heading higher here. Meanwhile, things that aren't heading higher is producer prices in the U.S. At least they weren't in March. The producer price index for the month of March was just 2.7%. That's the year-over-year headline number. Guys, the market was expecting 3.3%, and that's down sharply from 3.2% in February. Another big miss low on inflation, still higher than the Fed's arbitrary 2% target, I might add, but heading in the right direction. For now, it doesn't matter. The tariffs are going to kill this. But look, even the month-over-month number, look at this number here. Month-over-month in the U.S., inflation negative 0.4% for the monthly headline number. Now, that's driven largely by gasoline prices. Energy was a big driver here. But the market was expecting positive 0.2%, and that's down from positive 0.1% last month. Inflation took a dive in March. On the core numbers, even better. Well, not even better, but similar story. Core numbers, 3.3%. The market was expecting 3.6%. So you can see the core numbers a little bit higher. That goes to show you that energy was the big driver for those numbers this year. Now that's also down from 3.5% in a month ago. On a month-over-month basis, the PPI numbers, even in core, we got a negative number, negative 0.1. So it wasn't just energy that got cheaper in March. Other things got cheaper. I doubt that came as much relief to anybody out there, but at least the numbers were heading in the right direction. Now, the market was expecting positive 0.3, and that's down from positive 0.1. So it was a better than expected inflation print, but the market doesn't care because of the trade war. It's like, yeah, right before the house burned down, everything was going great. The temperature was great. Okay, take that one to the bank. All right, now look, we're running pretty long here, guys, so I just want to talk about this one. Bank of New York Mellon. We got earnings from J.P. Morgan, from Wells Fargo, from BlackRock, and from Morgan Stanley and Bank of New York Mellon. They were all pretty good this morning. All right, so there were no big warning signs in the bank earnings that you need to be worried about. And since we've run kind of long, we're not going to get too far into those. But there's one thing in this story about BNY that I want to talk about. All right, BNY's profit jumps 21%. Warns of uncertain outlook. There was a lot of warnings about uncertainty from the bank CEOs today. That's not surprising. But look at this first paragraph here. Bank of New York Mellon's first quarter net income jumped as the company reinvested maturing securities at higher yields, fueling a 6% increase in revenue. Oh, wow, that sounds great, right? Oh, higher yields. Earnings jumped. But what are they really saying here? All right, they had these bonds, these fixed income instruments, and the interest rates on them went higher. Remember what happens when interest rates go higher on debt. The value of that debt goes lower. So what they're talking about in this Bank of New York Mellon article here is, yeah, our income went up because we held those bonds to maturity. That's something that started during the banking crisis in 2023. All the banks stopped marking their debt instruments to market. They stopped worrying about what they're worth, and they started focusing on what they'll be worth if they wait until they mature. And now here's Bank of New York Mellon saying, okay, some of those things matured, and now we're reinvesting. We got paid back. We're reinvesting that money at a higher yield, so our interest income is going up. That's fine, but what that also means is that there's a lot of things sitting on the balance sheets of these banks that are worth a lot less than they're telling us. They're trying to spin this as a positive, but that also means there's a lot of risk that's sitting there. Now, I don't think Bank of New York Mellon is in danger of failing here. I don't think J.P. Morgan is, but this is exactly the mechanism that took down Silicon Valley Bank and Signature Bank and First Republic Bank and a whole bunch of smaller ones. It's those unrealized losses on the balance sheets caused by higher interest rates. And what have we seen for the last couple of days? We have seen interest rates move sharply higher in a very disorderly fashion. So just in this first paragraph here, they're trying to spin this as a positive. I'm not so sure this is really good news. All right. Now, other than that, the bank earnings were all pretty good. There was a lot of language about concerns about the trade war. No surprises there. But I really did want to point that one out. That is something to be concerned about. And I just want to say thank you so much to Thomas Owen. Thank you so much, Thomas, for supporting the channel. He says, what do you think will happen if the Dixie drops below 90? Look, if the Dixie drops below 90, the only way that happens is that means that the euro has gotten a lot stronger and the yen has gotten a lot stronger. If the Dixie goes that low, somebody in Japan has failed. All right, that's what that means. That means the unwind of the yen carry trade has entered that feedback loop where it starts to feed on itself and it spirals out of control. Honestly, I think some central bank action or the Treasury will back off. I think something happens before we get to that point. The Dixie going below 90 by itself isn't such an alarm. It actually helps U.S. exports for the dollar to get weaker. If the whole point of this, trade war is to bring manufacturing back to the U.S., a weaker dollar actually helps to reshore that manufacturing. But the knock-on effects, what that means for debt holders in Japan and people who owe money in Europe, that's catastrophic. I think big institutions fail before that happens. Now, we may see that. I don't know, but 90s, we just broke to 99. Let's not get that far ahead of ourselves. There's some good, but a lot of bad if that happens, Thomas. Thank you very much for the super chat, the support of the channel, and that was a good question, sir. I appreciate that. My man, the Pasta Man, is back. He says, just don't effing dance. Quoting The Big Short, Mr. Ben Rickard there. Absolutely, guys. I think that's probably in response to what I was saying about gold, right? Gold stackers, man, silver stackers, you guys are some patient MFers. You guys deserve a reward for what you've gone through and all the battering and the 9 a.m. price smashes that we've seen for years. And now we're finally seeing those prices rise. There is a tendency to dance because you are being vindicated. $3,200 gold. I think a few years ago, people would have told you were drunk if you thought gold was going to $3,200. Well, it's here. Just don't freaking dance. Understand what that means for people, guys. Good point, Pasta Man. Good quote. Good movie. Thank you, sir, for supporting the channel. Uncle Fedster says, happy Friday, Jack. Thanks for keeping us on top of things. Love the shiny. I like the shiny, too. Let's flash that silver bar one more time. I can't get enough of that. Happy Friday to you, too, sir. And you're welcome. It has been my pleasure, guys. It's been a crazy week. And I just, while we're on the subject, once again, I want to send a shout out to Mish for all the fantastic research you've done this week. Mish and I have been on the phone an awful lot, a lot more than normal. Mish has been on top of a lot of things. He's found some really good news nuggets hiding in the Bloomberg terminals recently, especially today. Also, all you guys who are sending me messages and news tips, obviously the volume of that has really increased over the last week or so. I try to get to all of it. I try to respond to all of it. It's just, it can't be done. But thank you so much. I do appreciate that, guys. All you people who have been doing that. It's team effort. Thank you so much, everybody. Appreciate it. KDM says China may as well just block U.S. imports at that rate. We may as well do the same. And KDM, that's effectively what we've done here. I mean, we are now essentially looking at a financial blockade between the two countries. Nothing gets in or out. I mean, there are going to be some things that we just absolutely have to buy, like our medicine. I mean, how insane is that? We get all our medicine from the country we're most likely to go to war with next. Is that not insane? Can you imagine if right before World War II, we got all of our penicillin from Japan and Germany? What that would have looked like for soldiers wounded on the battle? Like, good God. Now, as crazy as this trade war is, it's crazy not to have it when you think about it in certain terms also. And I'm not defending the tariffs here. I hate tariffs. They make my libertarian skin crawl. But guys, everything I've read among military academics and all the research I've seen has been 2027 is when the Chinese are going to go. And honestly, if you look at the war games they've been doing and all these things they've been rolling out lately, they might go sooner than that. All right. So how insane would it be to wait until the war starts to do anything about this? Because right now, the most surefire way to make sure that war starts is for the United States to project weakness. All right, look what happened. Within a year or two of people falling off the landing gear in Afghanistan, the Russians rolled into Ukraine. All right, the worst thing for world peace is a weak United States. And right now, our production capacity is a major weakness that the Chinese can exploit. And as much as this trade war sucks and as much as the economic pain is going to hurt all of us, myself included, just imagine if we didn't do this and nothing was done about American production capacity and then a war breaks out between the two countries. Then what happens? So not doing this, and maybe there's a better way to go about this, that almost certainly is. I don't know if there's an easy way to do an economic divorce between the two biggest trading partners in the world. Maybe there's a more careful way to do it. We sure as heck aren't being careful about it now. But this had to happen, guys. They're going in Taiwan. All right. Maybe their economy collapses before they can go. But then again, the economic collapse might actually expedite that because they will have to deflect their public anger outward. So, there's a lot of geopolitical implications to this trade war. A lot of it has to do with military and defense production. And it sucks, guys. It sucks. Let's put it that way. Thank you, KDM, for supporting the channel, sir. And you're right. This is basically a blockade at this point. Armando Reyes says 401ks took a hit when the stock market dipped. If it dips again, I think people will take out their 401ks. And once it hits the banks will prevent runs. So money leaving the stock market, preventing a bank run. I see. Once the money gets, people will try to run the banks to get the money out of their 401ks. I don't know. 401k hardship withdrawals have already been on the rise for quite a while. That's a story that's been kind of buried in the news. Ever since inflation took off in 2022, a lot of people have been dipping into their retirement accounts to maintain their current standard of living, which, it really sucks to have to do that. And people shouldn't have to do that, but it's also irresponsible to do that. You need to make adjustments in your life before you dip into your 401k to make ends meet. So that's already kind of been happening. I think there's probably a lot of financial advisors that are getting a lot of nervous calls from people who want to sell in their 401ks and are probably trying to talk them out of it. Look, I'm not advocating one course of action, guys. I'm never going to tell you what to do with your own money. I occasionally talk about what I do with my own money. That being said, people need to make adjustments. The whole concept of retirement, I've said this a few times, it's new, right? People never retired up until a few generations ago. You worked until you died. That was what 99% of the population did. And now the whole concept of retirement, it's only a few generations old, and it's already bankrupting us. I mean, Social Security is one of the big entitlements that's bankrupting the economy. So for all we know, the very concept of retirement may go down in history as a failed social experiment. It may not work because we're just not responsible enough to set aside money for life and not touch it until we're old and can't work anymore. How many people really have that discipline? Not many. So thank you, Armando Reyes. Appreciate the super chat, the support of the channel. Thank you, Steve Woitis, who says low PPI, an excuse for a May Fed cut. No, I don't think the Fed's going to cut in May. That could be offered up as an excuse. I'll be honest with you. The Fed is planting their feet and refusing to do anything right now. Look, the Fed is so worried about their independence, right? You're going to hear so much about Fed independence and, oh my God, they risk being fired and the president can't fire you. And the press is always poking that dog with a stick, trying to get Powell to say something mean about Trump or Trump to say something mean about Powell. Trump usually bites. Powell is not so easily baited. That being said, let's talk about that Fed independence. The Fed's not cutting right now, and I don't want the Fed to cut right now. I'm glad the Fed has finally learned how to do nothing. Took you long enough. But why is the Fed doing nothing now? And why did they cut 50 basis points in September? Which situation called for a rate cut? Using the Fed's traditional logic, which situation do you think called for rate cuts more, September or now? What's the difference? Where was the Fed's independence when they ran a 50 basis point rate cut out of nowhere, just as certain poll numbers were starting to shift in a certain direction? Let's be honest with you guys. There is no Fed independence. What Donald Trump is doing right now is the biggest FU up yours middle finger to the establishment global financial order, which includes the puppet masters at the Federal Reserve. Donald Trump is not an ally of the Fed. The people who own and run the Fed don't like Donald Trump, and so they're not going to do anything to help him, even if it means hurting their own financial interests. They need this trade war to fail so they can preserve the global order that has made them insanely wealthy. So I don't think the Fed is going to ride to the rescue here. And they didn't ride to the rescue this week when I think they would have during previous years. And that's one of the reasons why Bessent and Trump had to blink on that 90-day pause. The Treasury had to yield because the Fed was refusing to. It's a game of chicken between the Treasury and the Fed. Thank you very much, Steve, for supporting the channel. Sir, Armando is back and says, I asked myself, if I had to travel by foot, could I do it? Yeah, you could. It would suck. So I strapped on my vest, Monster Box, Arsenal, and Essentials. The answer is no. What to do? Okay, Armando, rule number one is cardio, brother. And the funny thing about body armor and ammo and all that stuff, your loadout, right? That stuff's heavy. All right. And well, yeah, you're not going to be able to carry too much of that by foot for too long. All I can say is rule number one is cardio for the scenario that you are discussing there. I won't get into too much detail because I don't want to get flagged for sensitive content by the algo gods. Thank you very much, Armando, for supporting the channel, sir. It's time to start jogging, brother. I need to start jogging myself, by the way. Kimberly, how do I pronounce that, Kimberly? Kimberly Rochelau? Kim R. Hi, Kim R. She became a YouTube member. Welcome to the Melonheads, Kim. Thank you so much for supporting the channel. I apologize, and I humbly beg your forgiveness for my mispronunciation, my non-regional diction. I don't get out much, Kim, but thank you so much for supporting the channel, and welcome. By the way, don't forget, 2 p.m. Eastern Time today is our weekly get-together on Zoom that we do for the magnanimous Melonheads on YouTube and Patreon every week. I got links down below and all that good stuff. Thank you again, Kim. Maybe we'll get to talk today at 2 p.m. Sarah Alexander says, please explain the yen carry trade and its significance like I'm 5. Thanks. All right, as quick as I can and as simply as I can. You borrow yen. You trade those yen for dollars, and then you buy something with those dollars, either a stock or a U.S. bond, okay? So the yen typically goes down. So when the yen goes down, the yen you borrowed get easier to pay back, all right? So you get paid there. U.S. stocks typically go up, so you're making even more money. All right. Now you owe a little bit of interest on the yen you borrowed. That's your expense, but you're making more of a return on the assets you bought in the United States. So you carry that debt, but you make money doing it because you're earning more interest than you're spending. That's the yen carry trade. But what happens when all of those movements suddenly reverse? The yen starts going up in value. So the money you owe is getting more expensive. The dollars you traded them for are going down in value. Oh, now you're losing on the Forex rate. But wait, there's more. The assets you bought with those dollars, stocks and bonds in the US, are also going down in value. Now you're bleeding cash. So what do? You real quick sell those assets. You trade them. You get them for dollars. You trade those dollars back for yen, and you pay off your debt. You unwind your yen carry trade. But what's the net effect of selling stocks? The value goes lower. What's the net effect of trading dollars for yen? The yen gets stronger. So for the people who are still in the yen carry trade, your action of unwinding it just made it even worse for them. So now they better hurry up and do it, make it even worse. Now it's a stampede, and it's a feedback loop. Every person who does it makes it even worse for the next guy. And that's how it gets very disorderly. And we're seeing that play out in real time here. That's been happening all week. Thank you, Sarah. That was an excellent question. I hope I explained that. By the way, guys, there's a guy named Michael Gayet on Twitter. He is at Lead Lag Report. He's been pounding the table on the yen carry trade for several years now. That's a great resource if you want up-to-date info on the yen carry trade. Also, Richard Bell, thank you, sir, says, strange world we live in, Master Jack. Look, I am a jack of many trades, master of none. But thank you very much, Richard Bell. These are strange times. Guys, we're watching history. I mean, this is one of those like 50-year storms, economically speaking. Now, it's the third one in the last 25 years, so maybe we have to revisit the frequency of that storm. But as far as the upset to the global order, what we're watching right now is on par with the closing of the gold window in 1971. So, make no mistake, this is history in the making, guys, and you are watching it in real time right here on Nobody Special Finance. A little bit of brand recognition there. Thank you, Richard, for supporting the channel. Pigos Trading Desk, what's going on, Mr. P? He says, I need a little Janet for my day. Well, yesterday, Secretary Yellen said that President Trump's trade war was the largest unforced error in world history. And I think that's kind of ironic because I think Janet Yellen was the largest unforced error in American history. And, well, it doesn't really matter. She doesn't care because she's collecting speaking fees right now. She's charging $15 million to give a 5-minute speech to interns at JP Morgan. And I'm sure that's a very valuable speech and has nothing to do with favors she did for the bank while she was in office. Oh, okay. This is Janet Yellen speaking in the third person there. That's unusual for her. It's kind of a little bit of a cross between Janet Yellen and Bob Dole going there. Bob Dole don't speak in the third person, right? Well, there is your daily Janet Fix Piggo. And dance, monkey, dance. What can I say? You drop $1 in the hat, the monkey will dance for you. I'm not above that. Thanks, Piggo, for supporting the channel. Thank you, everybody, for having your coffee with the melon heads. Be careful on leverage, guys. This thing is not over. Just be careful. Don't stick your neck out there too far. Otherwise, wear a helmet. Thank you so much for the generosity in the super chats, guys. Thanks also to my magnanimous melon heads on Patreon and YouTube. Links down below. Looking forward to talking at 2 p.m. for our weekly get-together on Zoom over there. Hi, Mom. Hi, Dad. I love you guys. Don't forget that like button and that subscribe button on the way out. And until next time, live small and dream big.